Hey, welcome back to XRP Financial Horizon. Here is something that should stop you in your tracks. A major global bank just said XRP is going to $28 by 2030, and at the same time, the very company that created XRP might be building something that works against that prediction. That is not a rumor. That is not clickbait. That is the actual situation unfolding right now. And if you hold XRP or you are thinking about it, the next few minutes could completely change how you see this asset. We are going to walk through the standard chartered forecast, what it assumes, why those assumptions are now being tested, and what Ripple's own stablecoin, RLUSD, has to do with all of it. Stick with us because this one has real depth to it. Let's start with what XRP holders have been living through this year, because the frustration is completely valid. Ripple achieved significant legal victories in its case with the SEC, although some legal matters and regulatory developments continue to evolve. Regulatory clarity around XRP improved significantly in several jurisdictions following key court rulings. Spot XRP investment products and ETFs have continued to gain institutional attention, pulling in over $1 billion in the process. By any logical standard, those are the exact catalysts that were supposed to send the price higher. Instead, XRP has lost more than half its value over the past 12 months and is now trading near $1, its lowest point since November 2024. Most assets sell off when bad news hits. XRP sold off while good news was arriving. That tells us something beyond normal market cycles is at play here, and understanding what that something is matters far more than watching the daily price chart. To put the current price in concrete terms, XRP hit around $3.65 in mid-2025. Anyone who bought near that level is now sitting on a loss of roughly 72%. That becomes even more uncomfortable when you realize those losses happened not because Ripple failed at anything, but because the market simply stopped responding to the wins. Legal clarity came through, institutional products got built, partnerships kept expanding, and yet the price kept sliding. When price and fundamentals move in opposite directions for that long, it usually means the market is pricing in something that is not fully surfaced in the headlines yet. In XRP's case, that something appears to be a growing question about whether XRP itself remains the central piece of Ripple's payment ecosystem, or whether it is quietly being challenged from within. Now, before we go further, the broader crypto context is relevant. Bitcoin has been trading down near $60,000 at multi-month lows, and that kind of weakness pulls virtually every other crypto asset lower alongside it. XRP is not immune to that pressure. But here is the distinction worth making. Most altcoins that fall during a Bitcoin correction do so because their own fundamentals are shaky. XRP is falling, while its fundamentals are arguably the strongest they have ever been. That makes the slide harder to dismiss as simple market correlation. It raises a more uncomfortable possibility, that the market is beginning to quietly question whether XRP's role in Ripple's ecosystem is as indispensable as the bull thesis requires. And that question connects directly to the standard chartered forecast and whether it can still hold up. Jeffrey Kendrick at Standard Chartered has set a target of $28 for XRP by 2030. From today's price near $1, that is roughly a 27 times return, turning $10,000 into something close to $270,000. At that price, XRP's market cap would be around $1.7 trillion, a number only Bitcoin has ever reached. That is a serious forecast from one of the most respected banking institutions in the world, and it deserves to be examined carefully rather than either dismissed or celebrated without thinking. What makes it credible is not just the number, it is the fact that Kendrick has not abandoned it even as the market moved against him. Earlier this year, he cut his short-term price target from $8 down to $2.80, but left the $28 2030 number completely unchanged. That selective revision signals real conviction in the long-term thesis. Bitwise, one of the most prominent crypto asset managers in the institutional space, also ran XRP through their own formal valuation model and produced 3 possible outcomes for 2030. Their optimistic scenario lands at $29.32, slightly above Standard Chartered's target. Their base case sits somewhere in the middle, and their bearish scenario comes out at 13 cents. A 13-cent outcome from the same asset that another model places near $30 tells you everything about how wide the uncertainty range genuinely is. Both numbers are grounded in legitimate analytical frameworks, and the gap between them reflects one specific unresolved question: whether XRP will remain essential to Ripple's transaction flow as the ecosystem grows. That question is what this entire debate comes down to. That brings us directly to what the Standard Chartered forecast actually assumes beneath the surface. The model rests on a straightforward idea. As Ripple's global payment network wins more volume, XRP captures a meaningful share of that volume as the bridge asset in cross-border transactions. Ripple built XRP specifically for that purpose, to sit between two fiat currencies and enable fast, low-cost transfers without the friction of traditional correspondent banking. More network volume means more XRP demand, more demand pushes the price higher, and by 2030, you reach $28. That logic is clean and entirely reasonable, but it depends on XRP actually being the asset doing the work inside those transactions. And that is precisely where RLUSD enters and starts to complicate the picture. RLUSD is Ripple's own US dollar stablecoin, pegged one-to-one with the dollar so its price never moves. For institutional clients and banks, that stability is genuinely attractive. If you are a financial institution settling a large cross-border payment and your bridge asset can swing 2 or 3% while the transaction is in flight, that creates real problems around risk management and reconciliation. RLUSD eliminates that problem entirely. It runs on the same infrastructure Ripple built, it is fast, and it never fluctuates. From a practical standpoint, for many institutional use cases, RLUSD is simply easier to work with than XRP. Ripple has been actively marketing it to their banking partners as exactly that kind of stable settlement tool. RLUSD volumes have been growing steadily and measurably since launch. However, growing RLUSD adoption does not necessarily imply reduced long-term demand for XRP, and the relationship between the two assets continues to evolve. That nuance matters, and we should not lose sight of it. Here is the core tension that creates for the $28 thesis. If Ripple's network keeps growing, but an increasing share of transaction volume flows through RLUSD rather than XRP, then the foundational assumption of Standard Chartered's model comes under pressure. The network can expand significantly, and XRP's price could still remain flat because the growth may not convert into XRP demand. The volume is there, the utility is there, but it could be accruing to a different asset. This is not a worst-case scenario invented to alarm people. It is an observable dynamic currently developing inside Ripple's ecosystem, and it is one credible reason why XRP's price behavior has diverged so sharply from what the bull thesis would predict, given the strength of Ripple's underlying business. To give Ripple's position a fair hearing, their leadership has consistently maintained that RLUSD and XRP serve different roles and are designed to work together rather than compete. In their framework, RLUSD handles stable value transfers where price certainty is required, while XRP handles liquidity provision and currency bridging where its speed and market depth offer unique advantages. If that complementary vision plays out in practice, both assets could grow together as Ripple's network expands, and the $28 forecast remains intact. It is a reasonable framework and likely reflects Ripple's genuine intent. The open question is whether institutional clients actually use both assets in that way, or whether they default to RLUSD for most cases because it removes price risk entirely. The transaction data over the next 12 to 18 months will answer that question more clearly than any forecast. From a market structure standpoint, the $1 level XRP is hovering around carries real significance. It functions as a psychological anchor for retail holders watching to see if it holds, and as a key reference point for algorithmic traders. The ongoing ETF inflows are providing a consistent bid beneath the price, helping maintain the level through broader market pressure. But if $1 breaks clearly, the dynamics could shift quickly. Stop-loss selling from holders who bought at higher prices can accelerate a move downward, and the next meaningful support levels are not particularly close. For someone with genuine long-term conviction in the $28 thesis, a break below $1 might represent the most compelling entry point this asset has ever offered. For everyone else, it is a level worth monitoring carefully before making any decisions. The macro backdrop is also worth addressing directly. Rate uncertainty, evolving regulatory timelines across international markets, and a general risk-off tone that has settled over the crypto space in 2025 are all contributing to a difficult environment for XRP. None of those headwinds are permanent. Regulatory clarity tends to improve over time, rate cycles turn, and appetite for risk assets eventually recovers. But the timing of those shifts is unpredictable, and in the meantime, they are adding external pressure on top of the internal RLUSD dynamic. For XRP to reach $28 by 2030, both the macro environment and the ecosystem dynamics need to resolve favorably. Neither outcome is impossible. Neither is guaranteed. On the question of institutional accumulation during this downturn, there are reports and on-chain signals suggesting that large holders have been buying XRP steadily as the price has declined. If accurate, that is a meaningful data point. Sophisticated capital with long time horizons tends not to accumulate assets they believe are structurally impaired. It suggests that at least some institutional participants view the current price as a genuine opportunity rather than a value trap. But accumulation alone does not guarantee a recovery. The structural question around RLUSD still needs to resolve, and accumulation during a downturn signals that the debate is alive, not that the outcome is settled. What this situation reveals more broadly is how crypto ecosystems actually evolve over time. Ripple built XRP, then built a network around it, then built a stablecoin on the same network. That progression is completely logical from a business standpoint. Ripple is equipping its institutional clients with whatever tools those clients find most useful. But it creates a dynamic where the original token may find itself competing for relevance within an ecosystem it was built to anchor. This pattern has appeared across multiple crypto ecosystems, and it is one that investors need to factor into their thinking rather than assuming the original token automatically retains its central role. The $28 forecast assumes XRP retains that role. Whether it does remains the open question driving everything else in this story. Wrapping up here on XRP Financial Horizon, the Standard Chartered $28 forecast is grounded in a real analytical framework from a serious institution and should not be dismissed. But the emergence of RLUSD as a growing settlement layer inside Ripple's own ecosystem introduces a variable that changes the math in ways the broader market conversation has not fully caught up to yet. Whether XRP maintains its role as an essential part of Ripple's transaction infrastructure or gradually shares ground with RLUSD will likely determine where XRP trades in 2030 more than any other single factor. Keep watching the volume data, keep watching institutional behavior, and keep watching this channel because we will be tracking every development as it unfolds. Do your own research, size your positions carefully, and we will see you in the next video.